straight. All right, I'm doing this right. Okay, so as Andrew said, he's not going to read this. This is a disclaimer, and the disclaimer says, when we provide you numbers and financial assumptions, these are models, these are built on some assumptions. You really want to dig deep and understand what are those assumptions. So when you read a development deal, they're going to show you these are the assumptions we've made on the interest rate costs. This is our contingency. So these are important. This is important information if you're making an investment in the exempt market space to understand, because it does impact your returns. And if interest rates go to 10% and the pro forma of the developer shows that it's 6.5%, it could virtually mean you lose all your capital. So you want to understand that risk. Currently, right now, I am not. Oops, I'm going the wrong way. Oh. Okay, good. So we've got inflation. We know that it's there. It's about 6.9% right now. We've got interest rates going up. Stock market's really volatile, and crypto. How many people bought crypto? I have a lot of people that I talk to that go, yeah, we just had to get into it. Luckily, they didn't buy a lot of it. Who are we? Integrated Equities is an exempt market dealer. So we're that exempt side of the private money. We really work with investors. We're focused on the real estate sectors. We're not technology. We don't work with startups. We look for companies that are growing. These are companies that have done their business for a minimum of 5 years, have strong track records, have done multiple exits, and they can provide those audited financial statements from the top 4. And you can independently verify it through a management consultant when we bring on a new product to our shelf. So, which one am I pushing? Okay, good. There's 3 of us on our team. I'm Cynthia, obviously. I work with Taylor Steele and Austin Carroll. These guys are amazing. They know their business, they love it, and we work very well together. So why would you invest in private equity? Well, I think one of the things that came very clear to me is a lot of my clients wanted to continue investing. They weren't able to get any more mortgage, so they decided they wanted to get into real estate. It's very hands-off. These are just key characteristics. You don't need a mortgage. You can use all of your registered accounts, self-directed. So there are a few institutions, as Andrew kindly pointed out, that you can hold a registered account, which is self-directed, that you can put these investments into. And also, you got to look at it. You could get involved in deals that you otherwise might not invest in. Example, commercial warehouse, industrial, self-storage, auto wash. Those are the types of things that you can get involved in, which, you'd need a lot more capital to do it. I'm not going to go through all those different structures because that would get a little bit boring, but there's different structures, and really the difference in why they're out there is how the income or the capital appreciation is passed through to the investor, and every offering memorandum will talk about tax considerations. When you use it inside a registered account, a lot of those tax considerations aren't applicable because there's no taxation. It's being sheltered from tax. Portfolio diversification is really important, but one of the big things I talk to clients about, and what we spend a great deal of time, is looking at your financial picture. What is your objective? What is your risk tolerance? What is your time horizon? When do you need the money? And is it suitable? Is the investment, the only way I can know if an investment's suitable for an investor is if I know all this information. So I'm not trying to be nosy. I really like to understand what you want to accomplish with the money. And certainly our investments aren't for all of your financial portfolio. They're for a piece of it, and they generally provide higher returns. So a lot of people look to the private markets because they offer higher returns. So every issuer that we have on our shelf isn't that big. That's our investment shelf, what our offerings are. We just look for quality, not quantity. We look for strong management teams. We look for people that have done a lot of exits. What I mean by that is they've actually proven that what they do, they can do, and they can deliver the results they say they're going to deliver. It also allows us to handpick different options. For example, we have a US multifamily value add option. We have a Canadian purpose-built rental option. So you can diversify geographically, you can diversify in type of product. Covered that. And then really, I think what I talk and focus with a lot of is distribution. How are you going to get paid? Where do you rank when the money gets distributed? Are you at the top? Or are you at the bottom? You want to be at the top. So you want to make sure that you understand that and what is in front of you, because that does impact overall returns. Our targeted annual returns range anywhere from 7 to 20+%. And that really is because we offer different types of investment options. There are development deals and they offer much higher returns, but along with higher returns comes much greater risk. So you really want to do your deep dive on the companies and the principles behind that company, their financial statements, to understand the pro forma and what their assumptions are, because you are taking a higher risk. And it's not really applicable for a lot of people, depending on your age, depending on how much income you make, depending on your family, like what are your needs? You really want to make sure that it's suitable. Minimum investment for us is $25,000, so it's a low minimum. All the registered accounts, we can help facilitate that. This is an example mortgage income fund we have. I think Andrew talked about this. This company has two different classes of shares. It basically offers one with a lower loan to value, 50%, and they pay around 5.5%. And the one that can go up to 80% loan to value is paying 8% or 7.96% right now. It's weighted around 68%. And they do monthly monitors and provide us with a report each month on the varying, because they're lending to private individuals for buying detached homes in Ontario. So depending on where that house is, the value might have gone down. So they really track that very closely and provide it to us and to our clients. Centurion is one of Canada's largest private REITs. I'm going to talk more about Centurion later, so I won't focus really on it, but it's been a solid performer since 2009, paying on average around 14% annualized. And it's a great one because you can either take monthly cash distributions or you can reinvest your cash distributions to compound your growth. This is the US multifamily value add program. They buy older assets. I'm also going to focus on this one because one thing I know from being in the real estate game for 30 years, multifamily really weathers recessions well. And we have a really strong thesis behind this. There's a lack of affordable housing in both Canada and the United States. And as interest rates climb, rental demand climbs, which will only make rents go higher. Greybrook is a development deal. They offer very long-term development. They have a superb track record. They're a large company and they really JV with the best builders in the Greater Toronto area. So for some clients, this might be feasible. For a lot of my clients, they wouldn't even consider it because it's 9.5 years, the current deal that we're offering. And like my one client said, I'll be dead before that's done. No, just kidding. Anyway, there's just, again, the suitability side is why we spend a great deal of time upfront talking to our clients to understand their position. Nationwide is a commercial self-storage and auto wash. It's a new like you're developing it. They buy the land. So the investors actually own the land and the two operating businesses when they're done. They're on their 6th fund right now. This company is actually very, very familiar with the public market space. It's Cato Bancorp is their managers. They've been, they work with portfolio managers. They're great at reporting and their due diligence and their pro formas, and everything they do is best of breed in terms of consultants. So very good numbers, solid performers. You get to participate in cash flow once the car wash is open and running, and also in the appreciation. The idea behind it is they'll build 4 or 5, 6 of these opportunities and they'll sell them to pension fund, sovereign wealth fund. They're looking for stabilized income. So that's kind of their game plan on that. So as I mentioned, I believe the recession will last longer, and I don't want to be the bearer of bad news, but I always know one thing. Whenever I actually sit down and plan and think about things realistically and make plans that deal with those realistic, I tend to come out of it better. So what if interest rates stay higher longer? I'm locking in some of my variable rate mortgages right now for 2 years, if I can. I'm negotiating hard on those variable rates because I don't want to just keep thinking about them every month, waiting for interest rates I don't think the governments really know what they're doing. And the Bank of Canada has explained that, yeah, oops. So I'm all about preservation of capital right now. And that's why I'm focusing on the multifamily. And I like hard assets and I like real estate. It's a great hedge against inflation. So we are in a lack of affordable housing in Canada and the US. They're not building enough of supply. They're building high end, but they're not building a lot of the affordable stuff. And that's really where we're focusing our energy. We have strong immigration targets. We're the highest in the G7. Like, we're bringing in 500,000 people for the next 3 years. That's our targets. They may even bring in more. There's just not enough supply for these. And people that come to the country don't automatically run out and buy. They don't even know where they want to live. So they're renters, and they're generally renters for a couple of years before they actually decide where they want to locate. So so we're looking at the cost. I think the comment was on the real estate prices, you know, the low end. Well, the reason the low end is the one that's pending sale is because what you qualified for when rates were at 2.5% was the high end, but now because rates are up, you qualify for the low end. And that's really what we're seeing in Vancouver as well. And our stats are a lot worse. 45% decline in sales month over month. So Vancouver, and I believe Toronto's in the same boat. We're seeing big hits because of our high prices, and just these interest rates will mean that the market is getting driven down. Here's the actual targets for the next 3 years, or over the last year and the next 3 years coming up. These are big numbers. That's the highest in the G7. We have the fastest growing population right now. We have the lowest number of dwellings per capita. Think about that. We're growing fast and we don't have enough housing. So where would you want to invest? I'm not saying invest in everything. I'm just saying being informed and looking at the areas that you want to invest. So there's a lot of, I think, catalysts to say we're going to see some good movement in rental rates and also some strong appreciation in these types of assets. I mentioned Centurion. It's a well-managed company. You know, it's a large private REIT. It has most of its mortgages, I think 83% of them are fixed. They did not jump into the variable rate mortgage. They've had around, the latest stat is 13.96% annualized return since 2009. They do offer a monthly cash distribution, and it's around 4% if you want to take that, if you need the monthly income. So it works for a lot of our clients, whether you're older looking for income, or if you want to reinvest it to get some compound growth, you can do that as well. You can actually even do a combination, and you can buy and have it reinvesting, and then you can convert it to the monthly income later on. So the beauty of this open-end fund, which means you can always get out of it and sell it. Now, there are some redemption restrictions. Again, when I meet with my clients, I explain those to them, make sure they understand them. The minimum time frame to not pay a redemption is 3 years. So you'd have to be planning to invest the money for 3 years with them. And they're all over. They're mostly across Canada, and they're also in select US states. Although in watching and looking at their updates, they are getting out of the US market. They prefer to be in Canada. That's where the bulk of their assets are. So they have 135 properties, around 20,000 rental units in 43 cities. So they have a machine, is really what that should tell you. They've built a very strong, systematic way to manage these properties, track these properties. You get a monthly change of value. So it's a great sort of, I think it's one of the staples in everyone's portfolio in our group. So had you invested $100,000 when it started, that would be worth around $500,000. And the beauty of Centurion distributions, it's tax advantage. So when you're getting these appreciation, it's taxed depending on the activity of the fund. The taxation is different. Sometimes there's higher income, dictated as higher income, but mostly it's capital gain taxation, even if you're getting the income. So it's a great, as I said, it's one of the staples in ours. So this is just, you know, what's happened. Nothing goes consistently up. It's had its ups and its downs. They've acquired about $1.5 billion in 2022, and they buy both forward sale new buildings that aren't even built, but they close on them. They're in Montreal. They bought a big portfolio, so they really like the Quebec market. And actually, stats are the Quebec market has the highest number of rentals per capita in any of the provinces. So it's a strong rental market. Kelowna, they added actually a medical office portfolio, where they bought into a share of a medical office to give them some stability, and they'll start adding more of this commercial. I mean, doctors, I think they're pretty good tenants, even in recessions, even in pandemics. So these are the kind of things the CEO, Greg Romont, has written. He wrote a white paper in May, and yeah, that was before everything started really, the shit started hitting the fan, pardon my English. But he wrote this, and if you read it, you think, man, he must have had a crystal ball. So he's, lots of intelligence going on. They're making very good strategic moves. They understand that why they like Canada. We lack housing. We're bringing lots of immigrants into this country. We need more housing. So they're big buyers of both the older and the newer. So just to wrap it, again, I put this in all of my clients' portfolios. I use it as, a great base to start in the exempt product. If you'd like a copy of the report, you can just shoot me a text and I'll send it to you. And like I say, it was produced in May, and ultimately it's everything that he said is sort of come true. So the final one, I'm just going to cover two of the multifamily because that's what I'm recommending right now, is Western Wealth Capital. This is a company based out of North Vancouver. They started in 2012. Since 2012, they've acquired 126 properties, 30,000 units, about $3.7 billion, and they've raised about $1.2 billion. We've been along with this company for the ride. It's been a great journey. They've exited 54 properties. So that's really what we look for. Can you deliver on what you said you were going to do? So their average annualized return has been 30% on all their exits. That's pre-tax, so you do pay tax on that, but it's a pretty nice return. Again, thesis is 4.6 million new apartments are needed by 2030. And they're running. And now with the pandemic and labor constraints and all the stuff that's going on, we're seeing a real slowdown in the building of these new apartments. So they're not going to be able to deliver. Top growth markets they look for affordable housing. They look for workforce housing in top growth markets. These are Class C, B buildings, and then they reposition them. They look to where the Fortune 500, 1,000 companies are moving, and they follow and they find assets in those markets. This is just an example. And if you go to cnnmoney.com, you can push, if I lived in San Francisco and made $150,000, my quality of life, I have a car, I can go golf every weekend, whatever. There's a quality of life. If you had that same 150,000 in San Fran, get you that. In Atlanta, for example, it's 78,000. That's all you need to make to have the same quality of life. So why? Mainly because of housing. Housing prices are a lot lower in these markets, and that's why these big companies are going there. They can attract top executives, offer them a great quality of life, and not have to pay them as much. And that's really why you're seeing the migration. They're currently in 6 markets. So they like a lot of the US Sunbelt markets. And they pick them for the reasons that I talked about. You've got Denver, you've got Las Vegas. Those are tech. Those are becoming huge tech funds. And Phoenix is the market that they started in. I believe they're the second largest multifamily owner in Phoenix. But it's been a really strong journey. It's a very simple, easy to understand business plan. Find an old building. 1970s, 1980s, in a great market that lots of employers are moving. These are moving like Amazon, like Intel. And in Phoenix, for example, the amount of money that's coming in there with TSMIC and the chip developers, and you've got Amazon building huge distribution centers. There is a lot of opportunity still in that Phoenix market. These are usually owned. The buildings that they find are owned not by professional property managers. They're owned by 2 dentists out of California decided they were going to buy an apartment building, and they just cannot manage the buildings. You really need to have a system to manage these. They're neglected. They need to be repositioned, and there's ample opportunity. So here's the markets they're in, and this is why, because we've seen huge population growth. This is the before. This is a classic, and this is the after. And this costs anywhere from $7,500 to $12,000 to do the update. And this is what they do. The other thing that they've done is they've standardized everything. So it's very easy for them to efficiently get this done quickly. And they've already bought all the washers. They've warehoused them. They've got all their they've just done everything on a standardization. In the pandemic, they opened up Western Wealth Communities, which was their property management division. And Jennifer Stachokis is their leader, and she is a technology whiz. So the cost for them to acquire a prospect is $2.82. In the industry, it's $10. The cost for them to lease an apartment is about $103. In the industry, it's $400. So what she has built is taken all the great technology out there and streamlined it so there's a lot of retention. So they build these websites, people can make application, they can do virtual tours, they can do Facebook tours. When pandemic hit, Jennifer put in so many things that people could actually rent an apartment without even seeing it and get what they wanted. And it was just incredible to see what she did with the company. And the last thing I'm going to talk about is I like to work with companies. I'm not going to say, I shouldn't really say this, but I like to work with companies that are run by women. And Janet LePage has always said, you can't do business if you're not doing it on human terms. They recognize their employees. They say thank you. They send out attaboys to all their maintenance people. Anyone that goes above and beyond gets recognition, and the whole company knows about it. So everyone's, yeah, Charlie. They create these amazing communities. We go on investor tours and we get off the bus and they're there, and you can tell. You can even tell the residents in the community are there saying hi to their property manager. They've changed, which was a pretty low bar. Property management isn't, thought of as, wow, it's really fun to be a property manager. It's not really a great job, but they've really changed the culture. It's about a culture, and it starts at the top. Rent-free Christmas. Every year for every community, they pick 7 families of those communities that could really use a hand up. They give them free rent for the month of December. They take it one step further. They ask the property manager who in this community has had a really tough go. And then they go and they buy all the gifts and the Christmas dinner. And they've even bought furniture for some people. You go to these and you're just crying your eyes out because it's such a heartfelt and it makes such a difference. The communities really, they all get glued together and it's a wonderful place to live. And that makes a big difference on your vacancies. We've got your back. This has been going on as well. In 2022, they raised $80,000. They gave backpacks to all the kids in each of their communities. Even some of the surrounding schools got the backpacks with all the student supplies. Now you think about this. These are people that are living on very strict budgets. To get the school supplies, if you have 3 kids, that turns into a lot of money for these families. Again, it's just about building a community and building everybody feels good. They produce a Q3 market report. I'm happy to send it to anyone that's interested. You can find out firsthand what these reports are and how diligent this company is. And it's been, as I said, a phenomenal journey for us with them. And I'm really excited because I know that they're in multifamily and I like multifamily right now. This will take you into our portal. If you want to look at all these deals in more detail, it's really simple. You need to confirm your email, answer a few questions, and you get access. And no obligation. No one's going to phone you and say, you got to invest now. That's not how we operate. We operate on inform, educate, and make people feel comfortable. Remember, you have 3 things: time, money, and peace of mind. You have to know